Coming up on the SBS On The Money podcast, a Qantas cyber attack, the Australian share market hitting a fresh record high, and retail sales are up, but how are consumers really feeling? That's all next. It is Wednesday, the 2nd of July 2025, a record close for the Australian share market today. The S&P ASX 8,597. We'll have the details with Martin Lakos from Macquarie Private Bank in a few moments. But first to Qantas, which has apologised for a cyber breach. The incident happened on Monday, but customers were only told about it today. 6 million of them have had their names, email addresses, birth dates, phone and frequent flyer numbers accessed after the airline detected unusual activity on a third-party platform used by a contact centre in Manila. The platform, however, didn't store credit card, personal financial information or passport details. No frequent flyer accounts, passwords or PINs were compromised, and there was no impact to its operations or safety of the airline. Investigations, though, are ongoing, although there have been similar attacks on other large global companies. So for more, I spoke with Daswin De Silva, professor at Trobe University. Daswin, how serious do you see this type of breach to be, and why do you think these scammers wanted this type of data?
Thanks, Ricardo. So I think it is quite a serious cyber attack because there is a fairly successful track record of this scattered spider type of attacks across different sectors, starting with the casinos in the US in 2023, and then in the UK with Marks and Spencer, Transport for London, and then more recently, in the last 4 days, there was some commentary on Hawaiian Airlines and United Airlines having disruption to their services. So it has to be taken seriously because of also the less sophisticated nature of the type of method used for these attacks, which is social engineering or impersonation, manipulating the help desk really of fairly large organizations that have multiple business functions that are spread across third-party providers. So definitely a lot to investigate and ensure that other sectors with where there are large organizations with a very large help desk service and a large customer base are also not compromised.
I think Qantas said that this happened on a third-party platform overseas at one of its call centres, right? Is there anything that Qantas could have done to mitigate it?
So Qantas have a fairly advanced data governance frameworks and cybersecurity adherence frameworks and committees, oversight committees, and so on. I believe Qantas could explore how these are also implemented across their third-party providers. So sometimes third-party or outsourcing parts of the business operations comes at cost saving, but this could also mean that some of those third-party providers are not adhering to the same cybersecurity safeguards, best practices as the parent company. So this could be a challenge for large organizations in terms of managing the cost advantage, but also ensuring that data security, data privacy, confidentiality of data is also safeguarded. So this is one area that they can look into a lot closer. And the second one is in terms of notifying customers of the breach. So there was a significant time lag between when they observed disruption to service or unusual activity on Monday, but the notifications happened on Wednesdays. So about 48 hours for further secondary attacks that are more targeted. So this data was not financially valuable, and from the looks of it, Scattered Spider is a financially motivated threat actor. And they could use this information, which is still identifiable, to send out further attacks that would compromise customers individually. So that's one of the other risks.
You've mentioned Scattered Spider a couple of times. For those that aren't initiated, that don't understand it, can you tell us what it means?
This is a group of hackers or threat actors that, based on information available, are based in the US and the UK. Seems to be a fairly novel cyber attack group because they're using simple techniques compared to some of the other attacks we've seen in the recent past. And the main technique is social engineering or impersonation attacks, where phishing attacks, SIM swapping, and multi-factor authentication, fatigue attacks. So they're trying to manipulate the help desk function of a large organization where the help desk has a different KPI because they want to make sure that the password is reset as quickly as possible and as safely as possible. But given their KPI is a faster service from start to end, this can be manipulated in terms of how much information they have and how frequently they try to intrude into how the help desk functions. So Scattered Spider, it could be an organization that is distributed across countries, or it could be just a type of techniques adopted by different groups. And this type of techniques, there were some arrests in 2024 following the breaches in the US, but they seem to have improvised from what happened in the US into the UK and now in Australia.
That is Daswin De Silva there from La Trobe University.
Now, Market Day on the SBS On The Money podcast.
Good day for the Australian share market. The S&P ASX 200 up 0.66% to a record high, 8,597. It was weaker in the morning and only really rallying after lunchtime. So to find out why and plenty more, I spoke with Martin Lakos from Macquarie. Martin, so the Australian share market was falling throughout the morning, but has really recovered and rallied in the afternoon. Why?
Pretty strong rally, Ricardo, particularly in the resources space. At the current level as we speak, should the market close at these levels, it's going to be a new all-time closing high. But of course, we continue to see volatility. And to some extent, the Australian market has well and truly lagged the strong rally in the US markets over the last week or so. So you might have an inference there. The market is starting to get a bit tired. Certainly seen a very strong rebound, obviously, where we were down about 14% through Liberation Day in April. We've recovered all of those losses. So again, a pretty strong rebound. The question of course, is where to from here? And I think the market's obviously going to be waiting to see next week what the Australian Reserve Bank decides to do on interest rates.
Bill, I mean, how much are overseas events weighing on investor sentiment?
Look, there's still an amount of caution, although you wouldn't have thought so with the way the US markets have rallied, but particularly in light of, we still don't know the blowback effect of the tariffs. Clearly, we saw, in a run up to the tariffs, a huge amount of activity, inventory building in the United States. Well, we're now past that. So we would actually have an expectation that the US economy will start to soften somewhat. We don't expect to see a recession, but certainly would expect that the impact of tariffs will start to see a slowdown and will probably be a global phenomenon. So that's something the central banks are going to be starting to deal with as well. Are they really going to continue to be focused on inflation, or does the growth side start to take a bit of priority? And we think certainly shorter term, a growth side will take that priority. And so we have an expectation of further rate cuts later this year.
Now, what about Australia, though? I saw some interesting analysis from the team at Morningstar yesterday that claim that the cost of living crisis is coming to an end amid falling interest rates. Today, we saw a 0.2% bounce back in retail sales in May, even though that was softer than expected. What do you think?
No, look, it's hard to get really excited about what the households are doing at this point in time. There's absolutely no doubt that the rate cuts we've had so far is assisting both the household budget and improving sentiment somewhat. But the retail sales numbers today that you mentioned was actually very mixed. So in fact, we had weaker components out of food, but slightly stronger in things like clothing and footwear. Now that may well be seasonal, given we've moved into the winter months as well. But I think to put that in perspective, that 0.2% rise through May, so it's only a monthly number, was well below expectations of looking for about a 0.5% rise. So again, it would certainly suggest that things are still soft. And it would also suggest that maybe volume growth in retail continues to soften as well.
Interesting to see the market turn around today, and that you, as you were mentioning, some of the material stocks or resources bouncing back. The Commonwealth Bank down for a fifth day in a row earlier today after hitting records as well. A lot of analysis about the Commonwealth Bank potentially being really overvalued. Are we starting to see a rotation from the financial sector to the resources sector? Is this an early sign, perhaps?
We don't think there's probably evidence yet of a decided or a definite rotation, although the resources sector looks very good value, but it's obviously down, and there is a question mark around global growth, whether commodity prices can bounce back anytime soon. But when we look at the banks, particularly compare Commonwealth Bank either internationally or to a domestic comparison, such as National Australia Bank, it really does look very expensive. So to give you an example, Commonwealth Bank is on 4.1 times price to book. The book value, National Australia Bank is about 1.9 times. So Commonwealth Bank is almost double that valuation criteria. If we looked at price to earnings, again, almost double, not quite. NAB is on 17 times on our numbers, and Commonwealth Bank on about 30 times. And NAB provides a much better dividend yield for investors at 4.3% versus Commonwealth Bank at 2.4%. But the rally in the Commonwealth Bank share price, it does look like there's a lot of international support, particularly given the huge investment that Commonwealth Bank has had in regards to technology and the benefits of that going forward. But we do think that it does look overvalued, and we've had an underperform on the stock for a while.
And finally, what are you telling your clients right now, and are there any opportunities for investors?
Well, given that we're now near all-time highs for the Australian market, and so the US markets are very, very strong, we remain cautious. There's no question about that. We do have an expectation of increased volatility, potentially an economic slowdown, not recession, but certainly a growth slowdown. And so we've really been allocating funds for clients, or recommending to be looking at alternative assets, particularly areas such as private credit, certainly areas such as infrastructure. So these are assets that are long-term investments, what we call long duration, and don't tend to get impacted as much on the day-to-day volatility. So that gives us a suggestion, Ricardo, that we remain cautious on markets. But overall, given that interest rates are coming down, we do expect possibly another 50 basis points coming off in the US, certainly another 75 basis points coming down in Australian interest rates. That's going to be supportive of risk assets such as shares. So, we're playing it cautiously, but we recognise that the growth might continue through 2026.
That is Martin Lakos there from Macquarie. That ends the podcast, but don't forget to give it a rating or review on Apple Podcasts or Spotify, and to give it a subscribe.
This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice, and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.